Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is our 89th episode, Active versus Passive Investments. Okay, thank you for tuning in. As you can see, I'm still doing the shows solo as Corey and I are respecting social distancing and we don't want to get too close in the studio today to record this. First, before we dive into today's topic, I hope that all of you that are listening or watching this are staying healthy and safe, and just realize that this too shall pass. I don't know when, nobody really does, but I know things like this don't typically last forever. And so again, like I said, we hope everybody is staying very healthy out there. Today, I wanted to talk about active versus passive investing. It's a very hot topic right now in the financial world, and I think it's something that our viewers or listeners, our audience, should know about. Now, my compliance department has been very adamant that I want to make it very clear that a lot of the viewpoints in here are my opinions, and certainly none of what I'm going to say today should be considered investment advice. If you do want investment advice, I will most certainly offer that to you, but I need you to email me at jake@falconwealthadvisors.com to set up an appointment so that we can go through your situation and give you more of our opinion. But for this topic, for today, it's very broad. We don't know who's watching it, obviously, and so we can't give out specific investment advice over video or audio. But let me talk again, so let's define what I want to talk about today. So I want to talk first about active investments. Loosely defined, this is typically when you have a money manager or a human being or somebody in there trying to trade the market. So they're buying securities, selling securities. Typically you can see these types of strategies in mutual funds or hedge funds. Again, this is a very loose definition. This shouldn't be the all-in, be-all definition. But for what I'm talking about for the scope of today's shows, I'm typically talking about actively managed mutual funds. So let's talk about the pros of this. Well, you have somebody looking at your investments, making informed decisions. So this is this person's or this team of people's sole job is to manage money according to the mutual funds criteria. One of the negatives to this would be potentially high fees. So they're not going to do this for free. And if you're using an advisor, this is a big piece here. If you're using an advisor to invest in a mutual fund, the advisor typically is getting paid a fee on top of the mutual fund. So you're basically paying two things for investments, two fees for one investment strategy. And then also another big negative is that typically mutual fund managers on average, they underperform the index. I think there's some study out there that approximately 80% of them have underperformed. Again, don't hold me to that. There's all kinds of studies arguing both points. But again, it's tough to beat the index when you're charging a fee. And then again, you've got human decisions in there. So that's active investing. And the argument for active investing is when you get volatile markets like that we're experiencing now. And the reason is if XYZ stock is going down and going to zero, if you're not managing that, you could ride that investment to zero. Or maybe ABC stock is down and you actually want to buy more of that. Well, you're not going to get that in something that's passively managed. And let me explain what a passive investment is. And these are typically exchange traded funds. Again, for compliance purposes, not all. Again, you should always continue to do your own research. But normally what a passive investment is, you just buy an index. So you might just buy the S&P 500 or buy the Dow Jones or buy, the price of oil or buy, the price of cattle or, whatever, dividend stocks, growth stocks, internationals. There's tons of indexes out there. And normally when you get a passive vehicle, it's very low fees. So that's a very good check mark. That's a good perk, but nobody's watching it, right? So if you buy the S&P 500, and you're looking for a passive investment, you just own all 500 stocks in the S&P 500. And if they go up, down, whatever, you're going to get whatever that basket performs at. Typically associated with passive investing are lower fees, like I said, but you have to be very careful because if you're using a financial advisor to buy passive investments, they are charging typically fees on top of the fees. So again, you have to be careful because advisors that use products like this, they're tacking on their fees normally on top, which can add up very quickly, and it really deflates the return or eats into the return that you should be experiencing from just going to these products directly. The big case for passive management is when the markets go up, everything's going up. Why do you need to pay a mutual fund? Frankly, why do you need to pay an advisor? Everything's going up. Where passive investments typically struggle are, like I just mentioned, when you have volatility and nobody's watching it, you might be writing everything down with it. And some stocks you may need to be buying more of, some you may need to be selling. Okay, so there's these big two camps. I would suggest, in my opinion, a lot of advisors use one or the other, or they use both, right? Which even makes it even more complicated if you have your advisor using both, because in one action, they're saying that passive investing they believe in, and the other they're saying active. Well, which is it? Why are you trying to wear two hats here? For us at Falcon Wealth Advisors, and again, this is just our opinion, we don't believe in using either. We feel that if a client wants to go out there and use a product, they absolutely should do so, but they shouldn't pay us a fee to do that. You can go down to the mutual fund and go buy their funds directly in most circumstances. You can go buy certainly an index fund relatively very inexpensively now and not pay an advisor another fee to do that. What we do at Falcon Wealth Advisors is we're custom building portfolios of stocks and bonds for our clients, and we're doing a combination of both. For us, we look to get the best of both worlds. But again, you gotta remember, we're not using products here. So we buy the stocks that we think are going to perform well over the next year or two, or wherever our target is. And if we feel like we need to make an adjustment in between that time frame, then we certainly do it. We're not day trading though. We're not in here trying to time the market or get crazy with it. So basically we're buying stocks that we feel represent a portfolio for our clients to hit their target objectives, and we monitor all of that in-house. We don't want to outsource it to a third party. The issue that we have is, and that we've had in the past, is that third parties, while they may be great at what they do, they have no idea what we're trying to specifically accomplish for our clients. And that we have problems with. We also don't like the fees. Mutual fund fees can be very high, they can be low, but if you tack our fee on top of a mutual fund fee, it's very difficult for us, in our opinion, to hit our clients' objectives. So at Falcon Wealth Advisors, we don't like products. We're gonna build out the portfolio for our clients, and we're gonna take active and passive investing, and we're gonna create, and we have created our own methodology that we use from our studies at the University of Pennsylvania's Wharton School of Business, where I've completed their investment strategies and portfolio management program. And that's where a lot of our decision-making comes from. And that's how we do it. It's that simple. So now is a great time to kick the tires. If you're working with an advisor or managing it yourself, you want to look at, are you in a passive fund or are you in an active fund? And you want to weigh the differences. And you want to double check your fees, because if you're paying fees, that's okay, again, but you want to be careful that if you're paying an advisor a fee on top of the investment vehicle fee, it can get very pricey, and that can really damage your portfolio and eat into your returns. With us, our clients just pay us directly. We're not using third parties, so we don't have to worry about hidden fees or using third-party products. Very good. Again, in our viewpoint, it works very well for us and for our clients. Okay, so enough of my soapbox on active versus passive. I thought it'd be a good topic, though, to talk about today, because again, with volatility in the markets, certainly is the time not to ignore your investments or to work with your advisor to understand what you own and why you own it. Moving on to my fun topic, I wanted to talk about a show that's out there. It's a documentary that ESPN produced called The Last Dance. Talks about the 1990s and the Chicago Bulls, one of my favorite franchises growing up as a kid. I don't really root for the Bulls much anymore, but I'll tell you what I've seen. As of the airing of this, there'll be 4 episodes out. So far, I've seen 2, and they were awesome. So if you're looking for some sort of sports fix, because there's not much sports going on right now, I would highly recommend you check out The Last Dance, which is a documentary that ESPN has produced. Very, very good, very well done. Shows you insights from Michael Jordan and the team that you might not have known, or I certainly haven't, and it's been really enjoyable to watch. I'll also leave you with one more item that, and again, if you're following us out there on social media, thank you so much. I'll do a quick plug. We're out there on Facebook, Instagram, LinkedIn, Twitter. Certainly, this is Upticks, our podcast that we produce out there on all of your podcast platforms, and it's also out there on YouTube. And certainly, if you have any questions or topics for the show, please don't hesitate to email them directly to me at jake@falconwealthadvisors.com. We have done a poll out there on Facebook, so we're calling it our Falcon Wealth Advisors Bird of Prey poll. That again, we sponsor out there on Facebook, and I've got the numbers here on my phone. I did want to take a look at them here. So we ran a poll out there for everyone to see if anyone is out there and they're getting into spring cleaning. I know Rachel and I have used this as a great opportunity to do some deep cleaning. We cleaned out our pantry a few weeks ago, and it's awesome going in there now. It's like we live in a whole new part of our house because it's clean, it's organized, we know where everything is. And not that I really got a lot of anxiety when I went in my pantry before, but now when I go in there, it's just really nice. And I know that her and I will continue to pick up projects as we go, whether that's in our backyard or basement or closet or bathroom, whatever we want to do. We're using this as a pretty cool opportunity to do some easy projects around our house just to make our house that much more enjoyable. For our Facebook audience, we had 71% of you said that you are using this as an opportunity to start your spring cleaning. The weather in Kansas City is starting to turn around as well, so I'd encourage you to make sure you're getting some fresh air. Please be out there, stay healthy, and like I said, this too shall pass. So thanks all of you for tuning in. We look forward to kicking out more content, and as always, please have a great week.